All right, let's dive right in. In this explainer, we're going to break down the RBI's fantastic analysis of how India's private corporate sector navigated the absolute storm that was COVID-19. This is a real story of resilience and revival, and we're going to give you all the key data and concepts you need to really nail this topic in your exams.
So, here's our roadmap. We'll kick things off with the initial shock of the pandemic and the crucial policy shield that helps soften that blow. Then, we'll get into the nitty-gritty of corporate performance, figure out who the winners and losers were, and take a hard look at their balance sheets. And of course, we'll wrap it all up with the most important takeaways for your exams.
Okay, first things first, let's set the stage. We have to understand the COVID-19 pandemic wasn't just a small bump in the road. No way. It was like a brick wall that the entire global economy, especially India, slammed into at full speed. This was a completely unprecedented challenge, a real acid test for our economic strength. Just look at that number, minus 23.8%. That is a real gut punch. A contraction of that size in just one quarter is, well, it's almost unheard of in modern history. To put it in perspective for you, it's like a quarter of the entire Indian economy just evaporated. For businesses, this was a disaster, with sales from manufacturing and non-IT services plummeting by a massive 41%. But in the face of this massive crisis, the RBI and the government didn't just stand by. They rolled out what you could call a policy bazooka, with more than 100 different measures. The ones you see here, slashing interest rates to make loans cheaper, pumping cash into the system, and giving companies a much-needed break on their loan payments, all of this was designed to be a lifeline, a shield to protect the economy and pave the way for a comeback. So the big question is, did that policy shield actually work? Well, let's find out by looking at how companies actually performed, starting with the most important number, their sales. And wow, this chart right here tells an incredible comeback story. After that complete freefall, sales didn't just crawl back, they absolutely rocketed upwards. This is that classic V-shaped recovery we hear about. It was powered by a perfect storm of pent-up demand, everyone finally spending after being locked down, and that strong policy support, leading to an amazing 32.5% sales growth in 2021-22. Now here's the real secret sauce to how they survived. Companies went into full-on survival mode. They cut their costs even faster than their sales were falling. Think about that. By getting better deals on raw materials and trimming other expenses, they managed to protect their profits and ride out the storm. This focus on cost discipline is a really important long-term lesson from this whole period. Okay, before we get into the profit numbers, let's quickly define a super important term for your exams, operating profit margin, or OPM. Just think of it as a measure of a company's core business profitability. It basically ignores all the financial stuff like interest and taxes and just tells you how good a company is at making money from its main operations. A higher OPM, that means a more efficient company. So this is where the story gets really, really interesting. You think that with sales falling off a cliff, profits would just get crushed, right? Well, look at this. The overall operating profit margin actually went up during the worst of the pandemic. That's just incredible, and it's proof of how incredibly effective that aggressive cost-cutting really was. But here's the thing. This recovery story wasn't the same for everyone. It wasn't a one-size-fits-all kind of deal. Some industries and different-sized companies did much better than others. So let's peel back the layers and take a closer look.
Within manufacturing, you could see a really clear divide. On one hand, the sales rebound was led by giants like petroleum and motor vehicles. That makes sense, as people started moving and buying again. But the real profit champions, pharmaceuticals and chemicals, for obvious reasons. Meanwhile, sectors like food and textiles, which are more tied to everyday consumer spending, really struggle to keep pace.
Now, this is a super important point, especially for your exams, so make a note of this. The recovery basically had two different engines. The big companies, the large firms, they were the ones driving the headline sales and profit numbers. But it was the smaller and medium-sized firms that were the real stars when it came to getting financially healthier and becoming more efficient. All right, let's shift gears now. We've talked about profits and losses, but let's look at the very foundation of a company, its balance sheet. Because this is where you can see the real, lasting changes that have set these companies up for future growth. So a huge trend that we saw across the board was deleveraging. Now, that might sound like a complicated word, but it's a really simple idea. Companies were going on a debt diet.
They were actively paying down their loans, cleaning up their books, and making themselves much less risky and more stable for the future. And that brings us to another must-know concept for your exams, the interest coverage ratio, or ICR. The easiest way to think about it is like a financial safety score. It tells you how easily a company can pay the interest on its debt using its current earnings. So the higher the ratio, the safer the company. Simple as that.
And here is the proof in the pudding. Just look at the manufacturing sector. Before the pandemic, their ICR was around 4. After the pandemic, it more than doubled to a stunning 7.7. I mean, that is a massive, massive improvement in their financial health. It's a crystal clear sign that these companies are now standing on much, much more solid ground.
Now, to help you remember the reasons behind this amazing improvement in debt servicing, here's a simple little mnemonic for your exams. Just think PCP. The first P is for strong profit growth. The C is for smart cost management. And the last P is for the fantastic performance of key performing sectors. So remember, PCP, profit, cost, performing sectors. Got it? All right, we've covered a ton of ground. We've looked at the data, the trends, everything. Now, let's bring it all together and distill it down into the most critical points, a guide built specifically to help you ace your exams. Let's lock in these takeaways. First, the big picture, the main story. It's a story of resilience and revival. Remember the initial shock, that historic negative 23.8% GDP drop? What was the response? The powerful policy shield. The key trend that emerged? Widespread deleveraging. And the key metric you have to know? The interest coverage ratio, or ICR. Next up, the performance numbers you need to have at your fingertips. Remember that incredible peak sales growth of 32.5%? What was the key to survival? Well, it was that costs fell faster than sales. And the surprising result of that, the OPM actually improved. And who were the heroes of this story? Manufacturing and non-IT services. And finally, let's lock in those details that will make your answers really stand out. Don't forget the different roles. Large firms drove the profits, but it was the medium and small firms that got financially healthier. That manufacturing ICR of 7.7, that's a golden number. The winning industries, chemicals, motor vehicles, and pharmaceuticals. And how did they fund this? Mostly through their own retained earnings, a true sign of internal strength. So what's the bottom line here? The Indian corporate sector has literally come through the fire and emerged stronger, leaner, and way more resilient. Their balance sheets are in the best shape they've been in for years. And that leaves us with this huge, tantalizing question for the future. Are we standing on the brink of a new, powerful private investment cycle that's going to fuel India's next big wave of growth?